Congress just passed a law that bans the biggest corporate landlords from buying more homes. And if you've been out there trying to buy a house, feeling like you're going up against companies with bottomless wallets, this probably sounds like exactly the break you needed. Less corporate competition, more homes available for regular people, and maybe, finally, prices actually start dropping. That's what they're promising anyway. But does the logic actually hold up? Because analysts who study this market are already saying the law is unlikely to materially improve housing affordability in the near term. So let's dig into what this law actually does, what it doesn't touch, and whether it changes a single thing for you. So this is what happened. The 21st Century Road to Housing Act became law on July 11th, 2026, after President Trump let the constitutional window run out without signing or vetoing it. And what the law says is pretty straightforward. Any company that controls 350 or more single-family homes can't buy additional properties on the resale market anymore. That covers direct purchases, transfers, mergers, bulk deals. On paper, every way these big players could expand is shut down. And this wasn't some razor-thin vote that barely squeaked through either. According to Resi Club, the Senate passed this thing 85-5, which is about as bipartisan as anything gets in Washington right now. Trump had already been laying the groundwork too, signing an executive order back in January, telling agencies to limit institutional investors. Both sides wanted their fingerprints on this one. And honestly, listen to how they're selling it. Senator Warnock called it the most significant federal housing package in a generation. Raymond James analysts described it as the first comprehensive federal housing legislation in nearly 2 decades. The White House called the investor ban the president's signature priority. Left, right, industry people, everybody's treating this like a historic moment. Problem identified, problem solved. Let's all take a bow. If you stop paying attention right there, you'd walk away feeling pretty great about it. But there's a massive gap between what this law says it prohibits and what it actually stops institutional investors from doing. Because the exemptions written into this thing tell a completely different story. So yes, the law bans these companies from buying existing homes on the resale market. That part's real. But it specifically carves out exceptions for build-to-rent developments, which is when a company builds new homes from scratch just to rent them out. It exempts fixed-to-rent, where they scoop up a rundown property, renovate it, and turn it into a rental. Foreclosures? Exempted. Lease-to-own programs? Exempted. Age-restricted communities? Also exempted. And even homes that are already owned by other institutional investors can be acquired under certain conditions. So the front door is closed, but there are back doors all over the place. And those back doors just happen to be exactly the strategies these companies were already shifting toward anyway. And this might be the most revealing detail of all. The law doesn't require institutional investors to sell a single home they already own. Every property sitting in their portfolios right now stays exactly where it is. The existing footprint is completely locked in. Now, the original Senate version of this bill actually had a provision that would have forced companies to sell off homes they acquired through the build-to-rent exemption within 7 years. That would have been real teeth, because it would have pushed those homes back onto the market eventually. But the National Association of Home Builders pulled their support over that provision, the House stripped it out, and the Senate just went along with the changes. Analysts at Evercore ISI described the final bill as far preferable for investors in the single-family rental industry compared to what the Senate had originally passed. The people whose entire job is advising Wall Street investors on this sector looked at the finished law and felt relieved, not worried. That really tells you something about how far apart the headline and the reality are. But even if you set all the exemptions aside, there's a more basic problem with the whole idea that banning institutional buyers is going to bring prices down. These companies were never big enough to be the reason prices are high in most of the country. According to Business Insider, institutional investors own only about 2 to 3% of the country's single-family rental housing stock. 2 to 3%. Nationally, that's basically a rounding error. But now, look at a specific market. According to Senator Warnock's office, corporate investors own more than 72,000 single-family rental homes in the Atlanta metro area, which is more than 1 in 4 such properties in that region. So nationally, institutional investors are barely a blip on the radar. But in Atlanta, they're a quarter of the rental housing market. The impact of this law depends entirely on where you live. And for most of the country, these companies were never the reason you couldn't afford a home in the first place. Now you might be thinking, okay Dave, but even if they're a small piece of the pie, removing any competition should help at least a little, right? And it might, at the margins, in those concentrated markets. But the bigger forces that are actually pushing prices up have nothing to do with corporate landlords. As of mid-2026, according to Business Insider, 30-year fixed mortgage rates are still above 6%. Median rents are sitting at record highs. And multiple experts, from the Bipartisan Policy Center, the National Low-Income Housing Coalition, Raymond James, all describe the central driver of unaffordability as a supply shortage, not investor activity. As Emma Waters from the Bipartisan Policy Center put it, it's not going to be an overnight solution. Even if every institutional investor magically disappeared tomorrow, the supply gap and the rate environment would keep prices high all on their own. The ban goes after a symptom, and a nationally small one at that, while the underlying disease just sits there untouched. And there's one more thing that makes the timing of this law feel a little hollow. Institutional buying of single-family homes had already pulled back sharply starting in mid-2022. The pandemic housing boom ended, rates spiked, and the financial math just stopped working for these companies, so they were already retreating before Congress even told them to stop. Banning someone from doing something they'd already decided to quit doing on their own is a lot less impressive than it sounds. So if you're tracking with me here, if the ban targets a small national slice, keeps the main growth strategies alive through exemptions, and showed up after institutional buyers had already pulled back, then what about those headlines you may have seen? The one saying Wall Street landlords are suddenly dumping thousands of homes onto the market? If you like these kinds of breakdowns and want more of them, hit subscribe and the like button. It genuinely helps the channel keep going. Alright, let's look at what's actually behind that sell-off number. According to data from Parco Labs, cited by Resi Club, the 8 major institutional landlords went from selling about 600 homes net in the second quarter of 2025 to over 3,000 in the second quarter of 2026. A jump of 408%. On the surface, that looks like Wall Street is suddenly running for the exits. But the selling happened before the law took effect, so it can't be evidence that Congress caused anything. And when you look at who's actually selling, the story gets even narrower. According to that same Parco Labs data, as of early July 2026, about 42% of all major institutional homes listed for sale came from one single company, Vinebrook Homes. And Vinebrook isn't selling because Congress passed a law. According to Vinebrook's own May 2026 SEC filing, the company is staring down nearly $266 million in debt coming due within 12 months and doesn't have enough liquidity to cover it. They're dumping homes to pay down debt. They're selling because they're broke. So the most dramatic headline number in this entire story, the one that makes it look like the ban is already reshaping the market, is dominated by one distressed company scrambling to avoid default. The 408% figure is real, but the reason behind it is radically different from what the headline wants you to believe. So if the ban doesn't move prices nationally and the sell-off headline is misleading, the real question becomes, who is this law actually for? Both parties got a popular anti-Wall Street vote locked in ahead of the November midterm elections, according to Raymond James analysts. Analysts at Evercore ISI predicted that Trump would claim to have banned institutional home buying, framing that, they warned, would create an uncomfortable, high-profile moment for the single-family rental industry. Now that's an analyst prediction, not something Trump has actually done yet, but the political incentives are pretty obvious. And it's worth pointing out that Trump withheld his signature not because he had a problem with the bill itself, but, according to Business Insider, over an unrelated demand that Congress first pass the Save America Act. The politics of this law worked beautifully for everyone who voted for it. And the institutional operators themselves, they're adapting, not falling apart. The exemptions keep their core business model intact. Build-to-rent and fixed-to-rent pathways are still wide open. Some institutional operators actually told Resi Club they're satisfied with the final bill. Sure, they're dealing with higher compliance costs and what Evercore ISI calls a new normal of political risk. But the companies that survive their own financial problems are going to keep operating, just through different doors. So where does that leave you as a buyer? If you live in an investor-heavy metro like Atlanta or parts of the Sun Belt, you may see marginally less corporate competition on existing homes. And that's real, even if it's modest. But if you live in the vast majority of the country, institutional investors were never a significant factor in your local market. And this law changes very little about what it's actually like trying to buy a home. So what does this honestly mean for someone who's out there trying to buy? The straightforward assessment is this. The law is a real legal restriction on the biggest institutional buyer's ability to grow through resale acquisitions. And that's not nothing. But analysts say it's unlikely to materially improve affordability in the near term because institutional market share is just too small nationally. The exemptions keep the main growth pathways intact, and the real constraints, supply and rates, are sitting right where they were before. It restricts the biggest buyers, but it doesn't reset the market. And this is a massive piece of legislation, hundreds of pages, and buried deep inside it are supply-side provisions. Zoning reform incentives, manufactured housing provisions, construction grants, accessory dwelling unit provisions. Multiple experts say these provisions are actually more substantive than the investor ban itself. Raymond James called the broader bill directionally constructive for housing supply. Libby O'Neill from the National Low Income Housing Coalition said, "After a few years, we're going to hopefully see this move the needle on supply." But a few years is the key phrase there, and federal law can't override local building restrictions, so whether any of this actually gets built depends on what happens at the local level. So here's what I'd actually keep my eye on if I were you. First, watch local inventory levels in your specific market, not national headlines. The law's impact is geographically concentrated, and what really matters is whether more homes are actually showing up for sale where you live. Second, watch whether those supply-side provisions get implemented, because they face real resistance at the local level, and that's where the fight moves next. And third, and this might honestly matter more than anything else in this entire law, watch mortgage rates. They affect your purchasing power way more directly than any investor ban ever could. The promise was lower prices. The honest answer is, not from this law, not for most buyers, not yet. But the things that could actually move the needle are knowable and trackable, and now you know what to look for instead of just reacting to headlines. If this was useful, hit the like button, subscribe, and tell me in the comments, do you think this law actually changes anything where you live?